Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati. I'm an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. What's going on in China is a question we received the most in recent months. We're not surprised by this question because the news flow relating to China's economic slowdown and regulatory crackdown on key sectors has dominated in recent months. Even otherwise, we think it is prudent for global investors to pay enough attention to what's happening in the world's second largest economy. On this week's podcast, we attempt to summarize what's going on in China at the macro, meso, and micro levels and discuss the prospects for Chinese investments. Let's start with China's macro picture. In many ways, China has been in a different phase of the economic cycle over the past several quarters. Thanks to its efforts in bringing the COVID-19 under control quickly in 2020, China emerged to be the only large economy to have posted a growth in its gross domestic product, GDP, last year. Against this backdrop, China's policy response has not been as strong as in the rest of the world during the past 6 quarters. At the same time, Chinese regulators also tried reining in excesses in some of the key sectors while also establishing a goal of common prosperity which aims to make the Chinese society more equitable. These developments have caused China's GDP growth on a year-over-year basis to slow to 4.9% in Q3 2021 from 18.3% in Q1 and 7.9% in Q2. However, according to Bloomberg Consensus Economic Estimates, China's GDP is likely to bottom in Q4 2021 at 3.5% before accelerating to 5.7% in Q4 of 2022. This would be in sharp contrast to trends in the US and Western Europe, where the GDP growth is likely to decelerate. So, 2022 could be the year where the Chinese GDP growth accelerates while the developed world growth decelerates. Taking a long-term view, the International Monetary Fund, IMF, estimates China's annual GDP growth to normalize to a more modest circa 5% growth over the next 5 years compared with almost 7% average over the years between 2015 and 2019 and compared with a 9-handle average annual growth figure over the past 40 years. While considering these numbers, one should keep in mind the extent of development China managed to achieve over years and where China stands now. That is, being the second largest economy in the world in nominal GDP terms. Moving to the meso picture of China, that is the sector level, 2 key sectors stand out. First, the real estate and property, and second, the technology. On the real estate and property, the regulatory tightening and high-profile credit events grabbed most attention. Construction and real estate account for 20% of China's growth, and therefore several regulations including the 3 red lines aiming to curtail the excess growth caused investors to worry about the prospects there. The tech sector was very much in focus of local and international investors as regulatory tightening increased. Especially the educational technology sector came under acute pressure following directives from the government suggesting companies operating in this segment to go not for profit. Regulatory review on anti-competitive practices in the sector intensified over the past year. Adding to this was the concern that US might ask some of the Chinese technology names listed on the US stock exchanges to delist. Investors and market watchers were also worried that restricting growth in China's technology space could bring down overall economic growth given the large representation of the sector in various consumer-facing activities. Getting more micro, some recent developments at the company level give some comfort. For instance, Evergrande, the world's most indebted developer, has been stumbling from deadline to deadline in recent weeks as it grappled with more than $300 billion in liabilities, $19 billion of which are dollar bonds. According to many news outlets, including Bloomberg's and Reuters, China Evergrande Group once again averted a default with a last-minute bond payment last week. A failure to pay would have resulted in a formal default by the company and triggered cross-default provisions for other Evergrande dollar bonds, thereby exacerbating a debt crisis looming over the world's second-largest economy. Whilst by no means we suggest that we're completely out of woods, this news flow should at least help in rethinking some of the extreme negative scenarios. The other micro development is in the consumer-facing IT sector. As you may know, November 11th, the Singles Day originally called Bachelor's Day, is a Chinese unofficial holiday and shopping season that celebrates people who are not in relationships. Thanks to the advent of e-commerce platforms, the Singles Day soon became a day when singles buy something nice for themselves. Indeed, the holiday has become the largest physical retail and online shopping day in the world. This year, e-commerce companies like Alibaba and JD.com posted around $139 billion of gross merchandise volume across their platforms on China's single-day shopping event, setting a new record. These record sales come despite worries about the strength of the Chinese consumer and the impact of Beijing's crackdown on technology companies. Of course, the growth rate of these sales has slowed to high single digits this year, but the point is that there is still growth despite intense concerns. What does all this mean to our investment strategy? Recent news flow has caused some market participants to argue that China is uninvestable. We push back against the extreme pessimism that has built up around China investments in recent months. For long-term global investors, China is too big to ignore, even after adjusting for an investing climate that is different from some of the developed world financial markets. China's share of global GDP, adjusted for purchasing power parity, was circa 18% in 2020 and is expected to climb to more than 20% in 2026. Chinese manufacturing sector contributes circa 30% to the global manufacturing. China houses 1/5 of the global population, boasts one of the highest middle income class populations, and the e-commerce penetration there is one of the highest in the world. Moreover, we think having a well-defined exposure to Chinese assets is more important now than ever, given the policy-driven accelerated decoupling between the US and China. Growth prospects for China's economy are expected to improve over coming quarters cyclically, and normalization in GDP growth over the next 5 years is not something unusual given the size of the Chinese economy. Looking ahead, we think policy hawkishness on strategic sectors will likely abate ahead of the Chinese Communist Party holding its 20th National Party Congress in autumn of 2022. Outlook for the real estate and property sector is conditional on policy easing at the local government level and liquidity easing at the central level. Whilst a big bang stimulus like in the past cycles is unlikely, we think a gradual and targeted easing of policy will help stabilize the sector in the near to medium term. For example, recent media articles highlighted that Chinese regulators are considering easing the rules to let struggling developers sell off assets to avoid defaults and hits to the broader economy. Whilst regulatory crackdown on tech sector has made headlines in recent months, we see the fundamental impact on the long-term story of the sector very limited. Whilst the sentiment towards China remained fragile, valuations across many segments have improved in recent months. Interestingly, portfolio flows into China continued despite the headline concerns. For instance, data from the Institute of International Finance, IIF, showed that flows into China's equities totaled circa $63 billion year to date, while flows into China's debt stood at circa $93 billion. Yet, China remains very underrepresented in global portfolios. Taking together all these considerations, from a cross-asset perspective, we are more constructive on China and other Asian markets now than we were a few months ago. For instance, we've recently upgraded Asia-Pacific equities, including China, to an overweight and remain overweight emerging market Asia investment-grade corporate credit. Thank you for listening, and we hope you found this podcast useful. In case you have questions or would like to get more information on what was discussed on this podcast, please reach out to your relationship manager at ADCB. You can also find a lot of investment-related content on our website at www.adcbam.com. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.